Good afternoon and welcome to the webinar hosted by Cornerstone Capital Group and the Investor Responsibility Research Center on a new report, Retail Automation, Stranded Workers, Opportunities and Risks for Labor and Automation. Our agenda today is introductions, an in-depth review of the research, a few words from the IRRC Institute on its perspective on the study, and then we'll take your questions. In terms of logistics for today's webinar, all of the attendees are in listen-only mode, but we do encourage your questions. You'll see a control panel on your computer screen. Throughout the presentation, if you have questions, just feel free to type those into the question box. Following the review of the research, we'll read the questions aloud and respond. We are recording this session and a replay will be available by tomorrow at www.irrcinstitute.org. We hope you'll share information about the report and this webinar on social media. You can find us on Twitter at IRRC Research and at cornerstone_cap. If you have any audio issues during the webinar, please contact GoToWebinar at 1-800-263-6317. We have two speakers today, Sebastian van der Zijl and John Lekumnik. Sebastian is the report author, and he is the Director and Global Thematic Analyst with Cornerstone Capital Group. Previously, Sebastian was an economic consultant where he advised on the development and finance of major infrastructure across Asia and Australia. Sebastian also worked with the Queensland state government on water and climate issues prior to establishing Australia's first government-owned carbon broker, EcoFund Queensland. John Lekumnik has served as Executive Director of the IRRC Institute since its founding. Along with the Board of Directors, he's led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He has decades of experience as an institutional investor, including time as the investment advisor to the New York City pension funds. John also is the author of the new book, What They Do With Your Money, How the Financial System Fails Us, and How to Fix It. Just a few words about the IRRC Institute if you're not familiar with the organization. It's a nonprofit that was established in 2005, and essentially what the organization does is it funds and disseminates objective and unbiased research on a whole host of issues that are important, to investors and to other stakeholders. Again, it's both academic and practitioner. We do sponsor an annual research award with two $10,000 awards. We're currently seeking applications for that, and the deadline is October 6th. We encourage you to take a look at our website for information if you're interested in submitting research on that. Also on the website is more than 60 research reports on a host of issues of importance to investors, and those are all available at no charge. I'll now turn the presentation over to Sebastian, and he'll talk to you for a few moments about Cornerstone and then get into a deep dive on the research. Sebastian?
Thanks, Kelly. Thank you all for joining us. Just briefly about Cornerstone Capital Group, it's a research-driven financial services firm which focuses on integrating environmental, social, and governance factors into everything that we do. And what we do is we are a wealth advisor for high net worth individuals, endowments, and foundations, as well as a bespoke research organization that creates reports like this one we have produced today for the IRC, and we also are a corporate advisor. So, a brief overview of what we're going to talk through today. I'm going to set the stage, talk about what we found and some catalysts. I'm going to talk about adoption of automation, particularly in technology initiatives being pursued by companies. Look at the range of stakeholders that might be implicated in the transition that we see potentially coming. And then we're going to talk about some investor implications, and both I and John Lekumnik will provide you with a series of questions that investors can engage with companies on. So a quick summary of the key findings. There is no understating the significance of retail within the US economy in terms of both its employment at 16 million as well as its GDP contribution. The report really focuses on two catalysts that we see as material for the future of retail. One is the low operating margins of online retailers, including Amazon, and the other is potential short-term wage pressure created by responses to income inequality in the form of minimum wage increases. Now, we recognize that US growth is inseparable from automation, and we've looked at the history, and it shows, however, that there are periods of very deep transition which have very jarring effects for a number of stakeholders. As noted at the very front of this presentation and in our press release, Our assessment does highlight that a significant amount of people within the retail sector currently do jobs that are at high risk of automation. Next slide, please, Kelly. So, in terms of the 30 companies we looked at, some takeaways. Most companies are discussing in-store technologies, the broader ones being self-checkouts. But what we start to see now is an emergence of more sophisticated technologies, sensor-based checkouts and smart shelves. What is interesting about the discussion about technologies is that we don't know a lot about labor. Labor and technology being both complementary and substitutes in this particular industry. These indicators include turnover, expenses, and employee satisfaction. As we'll discuss further in this presentation, there is little signs of explicit consumer strategy, experience, or convenience, and I'll define that further later. Interestingly, from a social policy, but also from a question about how you're treating workers, only 4 companies paid cashiers and associates above the living wage, and 5 companies of the 30 are pursuing what we believe to be future-proofing their business through enabling workers to skill up and transition away from jobs that will likely be automated. Finally, the report did isolate 2 particular stakeholders, women and people employed in these retailers in regional or rural areas that may be disproportionately impacted. Next slide, thanks. So what we have here at the moment in terms of retail employment is really that we have come significantly into a much higher level of employment over the last decade, and this can be seen on the chart on the left. But what is interesting is on the right, when we start to look at what these jobs actually involved and then compared them to the Oxford study on computerizable tasks, it showed that a number of these jobs, particularly cashiers and retail salesperson, had a vast majority which were automatable. This is not to say they are automated or that they are necessarily going to be automated tomorrow, but the question, what this really shows is that technology currently exists that would allow a vast majority of their tasks on a day-to-day basis to be automated. Next slide. So, right here we're going to talk about the 2 catalysts, Amazon and wage pressure, that we identified as really driving what we think is a different stage in retail. Online retail has grown rapidly, now accounts for more than 9% of total retail sales, and of course we know that Amazon dominates the e-commerce area at 43%. And on the next slide, what we're showing here is the reason why Amazon, it's not just because online retail exists that we are concerned for brick and mortar retailers, it's because of the operating margins that Amazon currently has that enables them to compete on price, but it forces companies to chase them down into these very low operating costs. And also Amazon doesn't, on the right, as you see from SG&A, doesn't face the level of SG&A costs as we see with the rest of the retailers. So this is a very significant change in terms of who the retailers are competing against, and that for us seems like a major catalyst for change. Next slide. On the other side, as we talked about, this short-term wage pressure we think is really driven by 2 elements. One is the acceptance or the recognition that retail workers are really facing dire situations in terms of pay, given that they are a large recipient of government payments. And the question of income inequality, which has been raised now significantly through a number of different industries, is suggesting to some policymakers that increasing the minimum wage is a way to address this. Now, this particular report doesn't go into the details of the minimum wage debate as much as it says short-term wage pressure is something that creates sort of a transitional moment within retailers and creates pressure on them. So their decisions will be informed by that pressure. So next slide. So what are we really seeing here? What we sort of came away with in terms of these 2 catalysts is that companies, particularly brick and mortar retailers, are kind of having to imagine themselves in a very tough environment. And the continuum that we saw in the literature was this idea of reimagining yourself potentially as a convenience or as an experience strategy. Now, that is not a clean definition in terms of practical, but it is a clean definition for the purposes of talking about automation technologies. Now, so that's very important as a differentiation. And what we mean by convenience in this context is the removing of friction for the sales process. So this really, in our mind, suggests sensors and checkouts that enable you to use your smartphone without having to talk to anyone, and the ability for your smartphone and for other devices to enable you to have questions answered very rapidly. The other is experience, the idea of coming into a store and actually having an engagement with a well-paid, trained person who enables you to actually make a better decision, make a better purchase. And in those two areas, we feel like those two give us some delineation between what technologies might be used and how retailers might be positioning themselves going forward as they adjust to these in this transition. Next slide. So what's important probably to step back before we jump into the technologies, really talk about productivity. Productivity has a big relationship to another element, and a number of elements, one of them being pay. Labor productivity and pay is generally quite related. And also the questions of automation. Generally, automation works quite well in sectors where productivity has stagnated in comparison to the rest of the economy. So what we see on the left is that retail productivity has actually grown faster than the industry, the broader industry. However, when we break that out on the right, it really shows that this has been driven by online and electronic shopping. And so on the next slide, we actually break out the 3 or 4 key bricks and mortar store labor productivity charts and show that automotive parts, supermarkets, and department stores have lagged the broader economy, and even things like pharmacies and building materials and supplies have not outstripped the economy. So these two areas where that automation may drive labor productivity, and there may be changes to the way labor is used and the implications for wages and employment as the basis for that. Next slide. So we then started to think about, okay, how are companies talking about technologies? This is not an easy area. We had to analyze earnings reports and presentations going back quite a while. We sort of came away saying that obviously the key technologies that have been talked about by a lot of companies are things like mobile devices, checkouts, kiosks, and beacons. But what we're starting to see very slowly is sensor-based checkouts, smart shelves, and smart price tags, with some discussion of autonomous robots. So this shows that while there is a range of technologies which are being talked about across the sector, and some of them have being more established and some that not. And this is important though, because companies are having these discussions. So the context of any technology discussion should also be around what the customer wants. You know, in some sense, we looked at this study here by Deloitte, really 2 separate studies trying to figure out what are the consumer sort of needs. And really there are 2 that strike us quite strongly. Obviously, knowledgeable store associates when having to make decisions about purchasing. So we often see that with more expensive or more complex items. And the other is that they want to avoid crowds and delays. So not necessarily are these mutually exclusive, or do they not necessarily can a company have both of these sort of organized in a way that allows them to maximize their benefits for the consumer. But in some sense, any technology that we see would be likely to target 1 or 2 of these major concerns by customers. So just broadly about the stakeholders, what we see interestingly in a stakeholder discussion is this question of the retail worker. The retail worker is actually quite a heterogeneous group. You know, some people think they're quite young. Some people think that the 2008 recession put a lot of people into the retail sector who previously weren't there. All that information is difficult to collect, but what we could find in terms of gender differences was that, for instance, cashiers, of which there are about 3.5 million in America, are 73% women. So significant automation of cashiers is likely to disproportionately impact women. On the other side, we're looking for information to work out if there's any geographical impacts that are disproportionate. And we sort of believe, based on the fact that a lot of these major retailers, particularly Walmart and others, regionally and rurally quite dominant, it is like in terms of their market share, it is also likely that they're dominant in terms of their employment share. So we would imagine any changes to the employment within these retailers is likely to disproportionately affect, assuming it is broadly sort of broad changes in employment would disproportionately affect rural and regional areas. So the companies we looked at is on the screen now. These companies were chosen based on market cap and comparability of data. We obviously captured quite a few different ones that have different strategies, different markets, different products. In the back of our report, we do a traffic light assessment of these companies based on the factors which are on the next slide. So this is the company assessment. The company assessment really focused on 5 key areas. One of them was, how much is a company discussing its technology initiatives? One of the big questions for us as investors is, we kind of know that every company is looking at this, but in order to work out what are they going to do, what their plans are in terms of their market, their strategy, their labor use, we kind of wanted to hear more and understand more about the technologies they're actively considering. The next is the changing labor profile. This is how much labor in the store and how well is that labor paid. As you'll see in a chart coming up, that can give us some indication of the strategy in terms of convenience or experience that a company is pursuing. Thirdly is minimum wage risk and exposure and government subsidization. This is just talking about what kind of pressure a company might face in terms of minimum wage pressure and short-term price pressure. I think that's important because any a company that is overly exposed in those areas may have significantly more pressure than other companies to change the way the labor is within the store. Investing in labor support the strategy. So this is a question of what we've seen, for instance, is that labor, companies are talking about evolved business models, and this is just an assessment as to where that company offers its labor the ability to learn and be part of the evolving use of technology and business models. Lastly, just a broad understanding of public perception, employee practices, social policies, and prior reputation. One of the reasons we put this here is because Mission Measurement, who we use their data for this particular study, has said that there is some relationship between how a company treats its employees in a retail sector company and the likelihood of purchase by a consumer. So companies that need to understand that also their labor, the treatment of labor does impact how people perceive and then purchase from their company. Next slide. So this is this sort of more complex assessment within this our report. It really focuses on trying to create a quantitative way to compare whether a company might be pursuing a consumer or an experience strategy. Now, what we can sort of see is there is a number of groups perhaps that very much look and feel the way in terms of this chart as the way they are. So Williams-Sonoma has increased the number of employees, but has also increased SG&A by employees significantly over the last 5 years. And so we'd expect them, as we understand, to be pursuing an experience strategy. The other question is convenience strategy, where we see a reduction in the number of employees per square foot, as well as a reduction in employees, primarily because in that scenario, we see potentially stores that are manned by people who are merely sort of greeters, and the rest of the store is highly automated. We do not see any in that. That would potentially be, for instance, an Amazon store, Amazon Go store. However, the top left is probably the one that the two less clear. One is L Brands. We've seen them move to paying people a lot more, but perhaps reducing the number of people on the floor to increase this sort of experience. The question is what technologies are going to use to make sure that they can continue to have productive labor in that basis. And the other side is this, the bottom right, which is unclear with more employees. This area is probably the least clear. For instance, decreasing the number of people, decreasing the amount you pay per person and then increasing the number of people for us is probably the one we feel least sure about in addressing the concerns both of crowding and knowledgeable sales workers, but also of using automation to make people more productive. So this is the one we're watching quite closely. It's an evolving thing. Next slide. So just quickly about wages. Only 4 companies pay above the poverty level wage. That's really, should these companies be pushed in terms of short-term wage increases? these top 4 or 5 companies are more likely to be able to say, well, we pay sufficient amounts of money. The rest of those companies are perhaps exposed. But there really are only one company, Sprouts, that had a predominant exposure to the minimum wage increases we currently see. So in terms of near-term increases in wage, we see Sprouts and potentially Costco as having the highest. So just quickly about the public perception of labor practices. It's an interesting set of data from Miss and Measurement. I referred to them before. They really asked consumers, which companies do you feel treat workers in a way that actually makes you more likely to purchase from them? And Costco came up as the highest rated. And as you can see, there's sort of a drop off. And by the end, you start to see, for instance, Walmart and Staples, they're actually being impacted in terms of customer perception and then customer purchasing because of the way they're perceived to treat their workers. So this is important, I think, in the entire debate about automation and labor. And we added this here because it sort of crystallizes this idea that you can't really half do this labor and automation sort of process. You have to bring it to a place whereby you have a labor force that is engaged and empowered. So these are stakeholder engagement questions. John Lekumnik next will also include his. I just wanted to add one more area that I thought was interesting from our perspective before we move on, the question of employee education, and we can talk about it separately as a question, but we do see the future of employment in retail probably requiring a lot more technical understanding. And so the companies that are better preparing their workforce through training around actual technology use are more likely to build the employees of the future. So on that note, I'd like to hand it back to John.
Thank you very much, Sebastian. First off, thank you and Cornerstone for the report. And I would urge the large turnout on the phone to on the webinar to get the report. It's available free of charge at irrcinstitute.org. That being said, I was asked by a number of reporters, and this report has gotten a fair amount of attention. Why is this an investor issue? Why did the IRC commission this study? And I think Sebastian has shown that. But before we get to that, sometimes when you're looking for one thing, you stumble over another. And clearly what we found here, although the report was designed to suggest how investors can differentiate companies in the third largest market segment in the United States, what we found was a major potential change to the workforce and the economy of the United States. And it's hard to ignore that when you are looking at a $6 to $7.5 million potential job loss. Although unfortunately every day seems to bring about more stories of layoffs and store closings that seems to make that potential more probable. As you will see in the report, over history, the history of automation and labor has played out in different ways, and I think Cornerstone is correct to suggest that this will result to some extent in a hollowing out of middle skill jobs. As Sebastian just said, more automation means that you need higher skill jobs for retail, but potentially less of them. And so you wind up with the higher skill jobs who are able to program, run, control a number of these automated functions, some middle school jobs in the middle. They're not all going to go away. And then jobs that are very low skilled, or what the report calls innate. So for instance, if you're a store greeter, that is a very human interaction. People want humans to do that, not robots. On the other hand, it's not a very skilled job and it doesn't pay very much. So it's hard to ignore that, particularly when you realize that if those numbers were to come to pass, the proportionality of lost jobs would be greater than the proportion of jobs that were lost in manufacturing. Moreover, with 36% of retail workers already receiving some sort of government assistance, that portends very major issues for economists and policymakers, and certainly rural municipalities, on what happens to the safety net, the social safety net for working poor. So we're likely to be, we in fact stumbled across a number of major public policy issues that we felt obligated to highlight. That being said, IRC Institute is first and foremost an investor-focused organization. And so let's go to the next slide and look at the issues from an investor's point of view. We do think the question is, what is the company's automation and labor strategy designed to accomplish? The convenience to experience continuum that is delineated in the report, I think, is a useful intellectual paradigm for investors to think about and to understand whether or not companies are being consistent, and that to me is the key issue here, whether they are being consistent in their labor policies and their automation spend. Just last week, we had the CEO of Walmart give a major address on automation and labor. And clearly, this is top of mind to the largest bricks and mortar retailer in the United States. It is, and if it's not, it should be top of mind to every other retailer in the United States. So the question for investors is, along that continuum, where do you want to be? What are the risks and opportunities? Who's being consistent in managing that? And perhaps most importantly, what do we know? Throughout the report, you will see that the disclosures around these issues from retail companies are very thin. It is interesting that in a major, perhaps the major challenge for retailers over the next intermediate term is fairly much ignored in the company disclosure and analysis that is in the proxies and 10Ks, and you get some indication, but not much. My hope is that as this becomes more top of mind, there is more disclosure so that investors can better understand it. In the meantime, it is certainly fair game for analysts and owners on quarterly calls, on IR calls, on inquiries, direct inquiries to management to understand these issues. So one of the major questions that arises out of this report is, what disclosures and metrics should a company make to help investors understand how it's executing on the strategy? So there is certainly advice for investors here, but there's also implicit advice for retail companies, which is you need a strategy. It would be nice if you disclosed your strategy, and it would be nice if you disclosed how investors should judge whether or not you're executing on the path towards that strategy. And with that, I'll turn it back to Kelly, and we'll take questions from the people on the webinar. Thank you.
Thanks, gentlemen. We're now on to the Q&A portion of the webinar. As a reminder, if you have questions, you can see on your control panel there's a question box. Just type your question in there. I'll read it out loud, and Sebastian and or John can take a shot at responding. Our first question is, what are the factors that might slow or forestall a move towards automating retail workers?
Sebastian here, I'll take that. So from our perspective, the scenario we've outlined here is really the transition. The questions of how long it will take and the factors that will drive or slow it are sort of multifaceted. I think any emergence of, as anyone can see, any emergence of Amazon within the context of your particular retail sector may drive companies to make decisions where they choose to take some labor out, particularly in the hollowing out effects that we see in the report. However, what's clear to us in terms of automation is that when particular retailers understand that they are an experience-based brand and they move towards that, we expect that they'll be using automation as a complementary sort of to the workforce, and therefore they are likely to be able to build out quickly a system that allows people to have that experience. We're talking about companies like Ulta and their Sephora brand. So that for us probably suggests areas of which we would see companies being able to slow the automation of labor through that purposes. The converse thing is that any sort of element whereby a company pursues a convenience strategy and wants to reduce the friction within the store, we see that as a bit of a red flag for the removal of labor, because we do think once you start to use kiosks and sensors and other things like that, it does remove the need for some degree of sales associates and cashiers.
Thank you. Our next question, what could retail workers do to better position themselves for the future?
Sure. So this is actually something Cornerstone Capital has put out a blog post on recently, just to follow up to this particular report. We had a sort of interesting discussion with a number of companies, and I think what struck us most interestingly, right, and every company said a similar thing, which is we don't think technology-enabled retail is going to be sort of fully implemented in a year or two, but by 2025, things will look very different, right? So that gives you an interesting time frame if you're a retail worker about the speed of this. And if we know technology as we've seen it, 2025 either comes very fast or it comes faster than 2025. There's a certain sort of exponential growth we see with the rollout of technology that suggests that those kind of timeframes are often maybe even a bit pessimistic about how quickly things can happen. So if you're a retail worker, the really question to you is, what do I do now? How automatable is it? Right? As we see, retail cashiers and retail associates are very automatable. And then you have to think to yourself, what skills do I need? And does the company enable me to get those skills? And what we saw was there were 5 companies in the report, including Best Buy and Walmart, and actually Amazon for that matter, and 2 auto parts retailers who provided professional training or access to tuition sort of rebates and reimbursements that allow people to study skills that potentially were not their day-to-day jobs. They're preparing them for what's coming next. The reason I say this is important is a retail employee who's able to move through computer programming or user experience interfaces or merchandising by studying is actually going to be able to move with the retail sector. And the corollary of this might be one of those rare occasions where this is a bit of a win-win for company and employees. All companies are moving towards this sort of tech strategy, are going to be competing for workers from Silicon Valley. And fundamentally, those people are extremely expensive. So my question to these companies is, can you use your existing labor force through education to actually build your future labor force for a much cheaper sort of outlay than what it will cost to compete for the programmers in Silicon Valley? So that is where we sort of see it. So employees should be looking for companies who are willing to reward your loyalty to their company with the support of going to learn new skills that allow you to move with technology, not be replaced by it.
Thank you. Our next question, what is the distinction between regional and metropolitan areas which you find will be differently affected? Is this primarily driven by the types of companies located in the different areas or other factors?
It could. There's probably 2 answers. One is it's probably a language question, which is regional and metropolitan, in our view, does differentiate between sort of, the study says that, the one that we quote says that sort of 46 metropolitan areas in the US, which we assume to be the biggest areas of human population, have a much lower saturation or market share held by major retailers. In this study, it's Walmart. So they, in major metropolitan areas, I think Walmart holds between 4 or 5% of the grocery market and even maybe less of the pharmacy market. Whereas in the regional areas, these companies, particularly like Walmart, own between 25 and 35% of grocery and pharmacy. So the difference is really that there isn't a much alternative within those, and that is the success, partially the success of Walmart, their ability to have captured large areas with their mega stores, that they serve people who travel a fair distance to come and shop there. So that's probably the factor that we see as the reason.
Just to add to that, this comes from a UCLA study that shows that Walmart possesses an average market share of 25% in metro areas with populations of fewer than 500,000. So that's the cutoff point, is metro areas with populations of fewer than 500,000.
Thank you. Another question. Do you have a view on the likelihood or feasibility of a universal basic income in response to job displacement from automation?
I'll take that.
John,
I think it's a little beyond the scope of the study. As I said, we sort of stumbled across major public policy points, and I think while Sebastian or I might have personal views on that, I don't know that it's certainly not an IRC Institute viewpoint, and those are major public policy questions that really have yet to be worked out in any sort of consensus form. I happen to have been at an academic conference this week in which some of those issues were being discussed along with a number of others about retirement income, but I don't think that's within the scope of this report.
Thanks, John. Our next question, does the size of the store impact the type and magnitude of automation?
That's an interesting question, and I think the way we thought about it is this. First of all, we think the technology application is definitely fairly uniform across small to large stores. Dealing with knowledgeable salespeople or reducing crowding or allowing people to check out faster, all those kind of areas I think contribute to both small and large stores. Now, these small and large stores can also be convenience or experience, depending on their particular approach. What I would say is there's an interesting relationship, I think, between large stores and the hollowing out effect. Stores like Walmart, which traditionally have had about 400 employees, of which about 100 are considered to be back office. So they're managers, finance people, people who work on payroll and other things. What's interesting about those stores is it's not just the technologies we see automating the retail experience, the retail kind of store floor, but we also see technologies that automate back office functions like enterprise software. So what's interesting is I think this in the technologies we've looked at, there isn't really a difference between small and large stores in how much can be automated from these sensors and checkouts and others. But what's really interesting is that there's a whole group of people who potentially, for instance, in Walmart, those people who are in finance and in this managing the stock and managing sort of employees and other things, they were relatively higher paid jobs, and they're under pressure at the moment from enterprise software. So that is an area that perhaps is is more specific to large stores, which is there's a whole group of people who weren't on the store floor who could be automated through other technology.
Yeah, I would agree with that, and I would emphasize that it's not just the visible technologies you see. And some of those have spillover effects even to small stores. So there was a front-page New York Times article last week about scheduling software that is being employed that enables larger commercial enterprises to, in effect, have what I would call just-in-time scheduling of front of the house sales and cashier personnel, and that has had a stressful effect on those retail salespeople, and it also has driven down income as there's on the one hand, one could say it's a more efficient scheduling. You have less wasted salespeople at times when there aren't people in the store. On the other hand, it has less salespeople, and those that are there see a widely fluctuating income from a full work week to a 15-hour work week, depending on sales trends. So those sorts of software solutions that are being used drive to both large and small stores, but it's not just the checkout lanes and robots and self-stocking shelves and the things that we used to regard as whiz-bang technology. It's also things as mundane as scheduling software that have an impact.
Thank you. Our next question, do you see follow-on effects for perhaps the real estate industry, both risks and opportunities?
Absolutely. I think you're already seeing them. Anyone who has looked at the shopping malls as real estate REITs preferred choices. I happen to live in Manhattan. You can see a change in the store makeup on any major street, Broadway in New York or Main Street in any town, where you actually are seeing this experience and convenience play out. What is on the streets are either total convenience, so things like drugstores that now have grab-and-go food sections, urgy centers, things like that, or high-end stores that require personal touch. There are very few sort of mom-and-pop general merchandise stores left on the streets of Manhattan. You have lots of restaurants. That's an experience that can't be duplicated. You have lots of drugstores. That's a convenience. You don't want to wait for a prescription, or you just want to grab a quick soda or something. And so you have seen it both in terms of big supply-demand changes, a la closing of major department stores and the value of malls in particular going down, and you've seen it in the change in population of the stores on main streets throughout America.
Thank you. The next question, inflection point. This research shows that thanks to automation and a bifurcated economy, the potential disappearance of 6.5 to 7 million retail jobs, which is part of a wider general decline of low-wage jobs. Meanwhile, criminal justice reform is generating larger numbers of prisoners seeking reentry into society. More automation leads to fewer jobs. Especially for ESG investors, what are the implications for addressing these questions of access and opportunity to gainful work?
Let me take the first shot, Sebastian, then you feel free to follow up. First of all, I'm glad someone mentioned ESG, because one of the issues, for those of you not familiar with that acronym, it's environmental, social, and governance. And one of the things that I think this report proves is that looking at investor issues through that lens can be valuable. It gives you a different analysis that might not have been obvious if you're just looking at financial statements. There are a couple of interesting places in terms of your question specifically, and it's an interesting question. Right now, there are rehabilitation training going on actually in correctional facilities, and the biggest user of them are home builders. Because the other thing that's happening is, of course, we are seeing undocumented aliens flee the United States, and there is less of a supply, certainly. And those are people who often worked for home builders. And so for those who are able, physical labor, which has not yet been automated in those areas, is available. In a longer term, more fundamental way, I think what Sebastian spoke about earlier, vis-a-vis the retail sector of retraining and specific job skill training, clearly seems to be the answer within retail, and one would imagine more broadly throughout the economy.
Thank you. Our next question, how are investors seeing treatment of labor, scheduling, safety, turnover in the metrics on investment screen?
Well, that was probably the most interesting finding. We had done a piece a year or two ago on the quick service restaurant area. We'd kind of seen a lot of discussion around labor costs. And most companies were sort of having pretty frank discussions about labor costs. If you look at our report, we really don't know the percentage of SG&A that is labor costs. Now, some people suggest that it's 14% of revenue, or it's about, 1/3 of SG&A. That is just a figure that people, 2/3 of operating costs, or 14% of revenue. That is just a figure that people have sort of said, like, well, this is what we currently think they pay. If you look at the way in which this works, though, these companies have very different employment sort of people they want to employ. And so the question is that using a general figure doesn't give you any perspective. So that was very concerning to us, that there's just a lack of discussion. And the second is, you've got all these companies saying, employees are our resource. Like, we sell because employees are good. Well, we'd like to see your employee turnover figures, please. Or if you don't have those, maybe some satisfaction figures, for instance, job satisfaction. Maybe those figures give us a better understanding of whether you actually do view your employees as perhaps your greatest resource. Again, we don't see those. So we had to use Glassdoor, and we had to use other sort of bits and pieces of data. And so that's not coming up on an investment like a Bloomberg screen. That's having to go out there and really scrounge for data. So what we really see here is this is a major issue. It's an issue that we'd like to all start to have a really solid understanding of, and yet we continue to be faced with a lack of data.
Thank you. Our next question, which I can take, are these slides available? By tomorrow, a replay of this session as well as these PowerPoints will be posted on www.irrcinstitute.org. And it looks like that concludes our questions. We have no more in the queue. So we thank all of you for your questions, and thank, of course, John and Sebastian for running through the report. If you do have any follow-up questions, feel free to reach out to either Sebastian or John. Their contact information is here on this slide. And this concludes our webinar for today. We thank you for your interest and participation and hope you have a nice afternoon. Thank you.